My name is Edmund Hale. I am a chronicler of markets, and this channel documents decisions made under pressure, the quiet moments before mistakes become visible and systems begin revealing the fragility hidden beneath confidence. I do not record profits, I record behavior. History changes, but people rarely do. In the early 1990s, Europe was attempting something ambitious. Governments across the continent were trying to stabilize their currencies by tying them together inside a system known as the exchange rate mechanism. The idea appeared elegant and reassuring. If currencies were held within narrow bands, volatility would disappear, trade would become easier, and the path toward a unified European economy would slowly emerge. To politicians and policymakers, the system looked like a step toward stability. But markets rarely cooperate with political design. The exchange rate mechanism demanded discipline from every country inside it. Governments had to maintain economic conditions that moved in similar directions, inflation levels that remained comparable, interest rates that did not drift too far apart, and fiscal policies capable of maintaining confidence in their currencies. As long as those variables remained balanced, the system could survive. The problem was that Europe was not balanced. Germany had recently experienced the enormous economic transformation that followed the reunification of East and West after the fall of the Berlin Wall. Rebuilding the eastern part of the country required massive spending, and that spending began pushing inflation higher inside the German economy. The Bundesbank, known for its strict discipline, responded the way central banks usually respond when inflation begins to rise, by raising interest rates aggressively. High German interest rates created a powerful gravitational force across Europe. Countries connected to the German currency inside the exchange rate mechanism suddenly found themselves forced to maintain similarly high interest rates in order to keep their currency stable. If they lowered their own rates too far below Germany's, capital would leave their economies and pressure their currencies downward. For the United Kingdom, the situation became particularly dangerous. The British economy was already weakening. Growth was slowing, unemployment was rising, and businesses were struggling with the weight of expensive borrowing. Yet, despite this fragile domestic environment, the government still needed to maintain high interest rates simply to defend the value of the pound inside the European system. To policymakers, the strategy still looked defendable. To the market, the system looked strained. And in the offices of one hedge fund manager, the situation looked even clearer. George Soros had spent decades studying how financial markets behave when expectations collide with reality. Unlike many economists who treated markets as perfectly rational systems, Soros believed markets were influenced by feedback loops, cycles where investor beliefs could reinforce price movements until those beliefs eventually collided with the underlying structure of the economy. He called this idea reflexivity. In Soros's view, investors did not merely observe reality, they interacted with it. Their expectations shaped prices, and those prices then influenced expectations again. When the cycle worked in harmony, markets appeared stable. When the cycle began to break, instability could spread quickly. To Soros, the British pound inside the exchange rate mechanism looked like a structure under growing pressure. And structures under pressure rarely fail slowly. At first, the tension surrounding the pound remained subtle. Currency markets often move quietly, while governments insist stability remains intact. And officials in London repeated the same message again and again. The United Kingdom would defend the pound and remain fully committed to the exchange rate mechanism. For many investors, that promise was reassuring. Central banks had defended currencies before. Governments possessed enormous reserves, the ability to raise interest rates, and the political authority to intervene whenever markets challenged their commitments. In theory, the Bank of England had the tools necessary to protect the pound. But Soros was not listening to speeches. He was watching the structure. Maintaining the exchange rate required interest rates high enough to attract foreign capital and convince investors that the pound would remain stable. Yet those same interest rates were suffocating the domestic economy. Businesses were borrowing less, unemployment was climbing, and consumer demand was weakening. The longer the government defended the currency, the worse the domestic economy became. And the weaker the economy became, the harder it would be to defend the currency. It was a feedback loop. The system required strength to survive, yet the defense itself was slowly destroying that strength. Soros believed that once investors recognized this contradiction, the market would begin testing the government's commitment. And once markets begin testing a promise, the outcome rarely depends on political will. It depends on capital. And the global currency market possessed enormous capital. Inside Soros Fund Management, the analysis continued for months. Soros and his team examined interest rate spreads, capital flows, government policy decisions, and the growing economic pressure inside the United Kingdom. Slowly, a conviction began to form. The British pound was overvalued. Maintaining the exchange rate required economic sacrifices that would eventually become impossible to sustain. Either interest rates would remain painfully high, deepening the recession, or the government would eventually abandon the system and allow the pound to fall. Most investors believed policymakers would hold the line. Soros believed the market would force the decision. He began building a position. The strategy was simple in design, but enormous in scale. Soros Fund Management borrowed large amounts of British pounds and sold them in the open market. If the pound collapsed, the fund could later buy the currency back at a lower price and keep the difference as profit. The position grew steadily. Then it grew rapidly. By the summer of 1992, Soros had built one of the largest currency positions the market had ever seen. Billions of pounds were being sold, and other traders began noticing the pressure building in the market. Rumors spread through trading desks in London and New York. Some investors dismissed the idea. Betting against a government was rarely comfortable, and central banks possessed enormous financial resources. A determined central bank could defend its currency for longer than many traders could remain solvent. But other investors quietly began following the same strategy, and the pressure on the pound began to increase. By September of 1992, the tension inside currency markets had become impossible to ignore. Every time the pound weakened, the Bank of England was forced to intervene, spending reserves to buy its own currency and push the price back upward. Billions of pounds were used in this defense. Yet the selling pressure kept returning. The market was testing the government. On the morning of September 16th, the situation exploded. Traders across the world began selling the pound aggressively. Soros's position alone represented billions of pounds, and other investors were now joining the move. The currency began falling rapidly as confidence in the government's ability to maintain the exchange rate started to fracture. The Bank of England responded immediately. Billions of pounds were spent buying the currency in the open market. For a brief moment, the defense appeared successful. Then the selling returned. The government announced a dramatic increase in interest rates, raising borrowing costs in an attempt to attract investors and stabilize the currency. Higher interest rates would theoretically reward investors for holding pounds and discourage speculation against the currency. But the market interpreted the move differently. Instead of seeing strength, traders saw desperation. The selling intensified. By midday, the Bank of England had spent enormous amounts of money defending the pound, yet the currency continued falling. Traders around the world sensed the moment of weakness and pushed even harder. The central bank raised interest rates again. Still, the selling continued. Finally, the government faced a decision that could no longer be avoided. The United Kingdom would leave the exchange rate mechanism. The pound would no longer be defended inside the system. The currency was released into the open market, and almost immediately it collapsed. The day would become known as Black Wednesday. For George Soros, the result was extraordinary. The pounds his fund had borrowed and sold months earlier could now be repurchased at far lower prices. The difference between those prices created one of the most famous profits in financial history. Estimates suggested Soros earned roughly $1 billion from the collapse of the British pound. But the significance of the event extended far beyond profit. A national central bank had attempted to defend its currency using reserves, interest rates, and political commitment. Yet the collective force of global markets had proven stronger than the promise of policy. Financial media soon began describing Soros as the man who broke the Bank of England. But the trade itself was not simply about attacking a currency. It was about recognizing when a system could no longer defend its own assumptions. My name is Edmund Hale. I do not record profits. I record behavior. The story of George Soros and the British pound is often remembered as a battle between a single investor and a national central bank. Yet the weakness in the system existed long before the trade began. The United Kingdom had committed itself to a promise that economic reality could no longer support. The market did not create that contradiction. It revealed it. Markets repeat this lesson again and again. Prices are shaped by the tension between belief and reality, and when belief drifts too far from reality, the correction rarely arrives gently. What appears stable can unravel quickly. What appears permanent can disappear in a single day. The fall always feels sudden, but the pressure that creates it is almost always visible long before the moment arrives. And that is where the real story lives. Not in the crash itself, but in the quiet period before it. This is before the fall chronicle.